Yen falls, Omicron fears easing and interest rate hikes are imminent. By Tom Westbrook SYDNEY. The yen was pinned near a 5-year low on the dollar on Wednesday and nursing losses on other crosses as traders wagered Japan would lag a looming wave of global policy tightening as inflation gallops ahead around the world. The yen tumbled through support, which now turns resistance, around 115.50 per dollar on Tuesday, to hit the 5-year trough at 116.35. It hovered around 116.05 through a quiet Asian session. The yen also dropped through its 200-day moving average to a 2-month low of 131.45 per euro, recovering slightly to 131.00 in Asia. It made a more than 6-year low against the Swiss franc and a 7-week trough on the Aussie, recovering slightly from those levels on Wednesday. Sharply higher COVID-19 case numbers in the U.S. appear to be primarily boosting supply chain concerns and fears of higher inflation in the U.S., rather than boosting growth concerns, said Nomura economist Andrew Ticehurst. This has led to a sharp jump in U.S. Treasury yields in the first trading days of the year, and the widened gap on Japanese yields, anchored by the central bank, has hurt the yen. The 2017 high at 118.60 may be the next natural target, and cannot be explicitly ruled out for now, said Terence Wu, FX strategist at OCBC Bank in Singapore. A similar dynamic has the euro under pressure as European policymakers are likely to be behind peers in Britain and the United States on tightening. The common currency held near a 2-week low against the dollar at $1.1288. And hit an almost 2-year trough of 83.32 pence. The risk-sensitive Australian and New Zealand dollars struggle to resume an attempt to rally as fears of Omicron, derailing the world's recovery, subside. The kiwi last bought $0.6803 and the Aussie $0.7228. Both remain shy of resistance around $0.6857 and $0.7270 respectively. The US dollar index was rangebound at 96.269. Minutes from the Federal Reserve's December meeting, due to be published at 19 o'clock GMT, could underscore U.S. policymakers' newfound sensitivity to inflation and their readiness to act. Partial U.S. labor data on Wednesday and non-farm payrolls on Friday will also be watched for a guide to the trajectory. Fed funds futures show traders see rates lifting off by May. Analysts at Standard Chartered now expect 25 basis point hikes in March and June rather than one hike in September. U.S. 2-year and 5-year yields stand near pandemic highs, and benchmark 10-year yields are up about 14 basis points this week. Against that leans some element of caution as markets remain thinned by holidays. Despite the explosive rally in U.S. dollar to Japanese yen, I still can't get excited about the idea of a stronger USD right now, said Brent Donnelly, trader and president at analytics firm Spectra Markets. The rates move certainly has grabbed everyone's attention, but it's hard to know how much to read into a move on the first trading day of the year. The big question remains, can the Fed hike more than a few times without breaking everything? Sterling, meanwhile, has rallied about 2.7% on the dollar in a dozen trading days since December 20th as traders also reckon surging Omicron cases in Britain won't deter the Bank of England from lifting rates. Prime Minister Boris Johnson is resisting lockdown measures and hoping caution and vaccinations can prevent serious illness. Despite surging cases, the pound last bought $1.3527.